in real simple terms, active share, all it is explaining is, as an active manager, how much overlap do you have with the benchmark? So think of any type of portfolio of having really two parts. One is to replicate a passive benchmark, and think of 100 minus the active share as replicating a passive benchmark. And then the second part of that is your true active portfolio that doesn't replicate the benchmark, and what you're charging active management fees for. And so in essence, that statistic, which is now commonly cited, is really just looking at your overlap between yourselves and the broad-based benchmark that you choose to be measured against in the marketplace. As more and more of the industry recognizes that passive and active aren't necessarily to be competing solutions but complementary solutions, it's really about assessing when should I be using passive, when should I be using active, and then when I make the decision of active management, what are the attributes that I'm solicitous of? And so really, I think it's important to make sure that, and we don't think it's the exclusive measure. I think that's one of the things when we're having conversations in the marketplace. Active share is a tool in the toolkit. It should not be then the ultimate arbiter of what somebody does from an active management standpoint. I really think it's looking at active share, which does look at your overlap versus the benchmark, but looking at specific attributes. You look at the concentration level of your portfolio. You look at the tracking error, which kind of quantitatively measures your deviation quarter to quarter and annually versus the benchmark. You look at your deviations at a sector level. You look at your deviations at a cap level, and then maybe at a country or region level for an international or global portfolio. So we think that active share is an important tool, and from our perspective, I think what we try to then do is look at and make sure that our stock selection is really the driver of our performance going forward. And that's where I think it's been very instructive in the marketplace. ClearBridge's approach is one where there's all these type of things, in baseball and out in parlance, everybody will focus on kind of on-base percentage or those type of things, where Earl Weaver 25 years ago didn't call it anything. It's just how he applied his practice for the Baltimore Orioles. And I think that's how ClearBridge culture kind of grew up. Investors like Hirsch Cohen, John Good, Richie Freeman, who've been doing this for 30 to 45 years, really invested before benchmark measurement and relative performance was as big part of their parlance. And so I think when you have that as part of your culture, it's easier to implement. And so we don't have to kind of react to an industry trend. We've already been doing it. I think it's also important to recognize that's how we practice. When the Russell indices on the growth side were over 50% of the benchmark in 2000, right? And people were asking us, well, aren't you risky by having growth portfolios that are 15 to 20% weighting? And we said, you want to define risk in a different way. It's important to think about risk not just as deviation from benchmark, but really thinking about what's the best way to generate returns for our clients. And like I said, probably 10 years ago, that was something that many of our institutional clients frowned upon, or consultants and plan sponsors. And ironically, those are the people who are now leading this discussion, and frankly talking about alpha-beta separation and the need to either go big or go home. And so we think we're kind of very well positioned in this sweet spot of where the industry is going, and not having to react to it, to have really had the culture and the portfolio constructions and tools in place. I think investors tend to oversimplify a single term. So active share, there may be an interpretation that high active share is always better. And that may be true, but it may not be true. We always say that high active share just amplifies skill. You can create a one-stock portfolio with an out-of-index bet, and you have 100% active share. That doesn't mean you're going to generate the same type of returns that aggressive growth, which has been employing the same kind of philosophy and practice for 31 years, is going to have with 95% active share. So we think it's important to have as a tool in the toolkit, but again, I think it's important to peel the onion back a little bit and make sure that your active share is around the attributes that you want. So it can be a diversified set of holdings, it can be a more concentrated set of holdings, it can be things that have more kind of, let's say, cap deviation, big sector bets versus tight sector bets. All those things become part of the mosaic of active share may be something you screen for, but now you have to look beyond that. And like I said, I think that's where ClearBridge's product set is really well aligned, because we don't just have one flavor of high active share. We have kind of 4 or 5 flavors within our suite of offerings to clients. I think this again ties to the portfolio construction aspect of more and more sophisticated clients can replicate passive exposure or style factors. So a simple example, and we think that the active share kind of conversation helps frame our value proposition with our fees in a much more clear way to clients. So the way I would walk through that is, if you are a mutual fund that charges 50 basis points, but your active share is 40%, on that 60% that is passive, you can just buy that out in the marketplace for 5 basis points. So that gets you to a weighted average of about 3 basis points. To get the other 47 bips on that 40%, you got to charge 117 basis points on that. So now, instead of saying my management fee is 50, what you're really charging for the pure active portion of your portfolio is 117 basis points, which I think in the marketplace seems high. But if you have a high active share strategy that charges 70 basis points in the marketplace, and let's say it's 95%, you can say my clean kind of active management fee is somewhere around 75. And we think with all that's out there in the marketplace in the active side, with alternative investments that charge a lot higher than that, we think that's something that has really solved for client solutions and provided strong returns over consecutive market cycles, is something that clients will want at that price point. And so we think that there will be things that get squeezed in the middle. Like I said, the kind of closet indexers, I think there's going to be a lot of consolidation in that space, and I think the messy middle is going to go away. And I think on the very high fee side, I think you're going to see a lot of compression there. But relative to what's out in the marketplace for what we do from an active management standpoint, and when you use active share as a way to understand your fee structure, we think we provide a compelling value proposition to our clients.